Dave Ramsey is super opposed to any type of debt. He wants to go full cash, only assets, nothing on that side of the ledger, no liabilities, and just grow, grow, grow. But that might not be possible for many Americans or many people who are watching this. I'm gonna play the video, and then when there's a good place to pause, and then we'll comment.
This hour in Cincinnati. Hi, Jeff. How are you?
Hey, Jet. I'm doing good, Dave. How are you?
Better than I deserve. What's up?
Well, I'm kind of a new follower. I just found you earlier this year. Had some questions about potentially refinancing our house.
Mm-hmm.
We originally bought it back in January of 2021. This was obviously before we knew you, and we got a 30-year loan at 2.5%.
Mm-hmm.
And now kind of considering, do we move to a 15-year? But my biggest concern with that is that we're giving up that 2.5% rate to go somewhere around 5% or so.
You're right to be concerned.
So to make more sense,
I would not do that. You're right. Okay. No,
so
you keep the existing.
Yeah. I wouldn't do that either. What? You have a 2.5% interest rate, right? And you're gonna go to a 5%.
There's no way that math makes sense. Whoever that loan officer was, oh my gosh, get him out of here. Get him the hell out of here. Like you said this is a 2-year-old video, right?
This is a 2-year-old video, yeah. So this is post
This is even
Dodd-Frank.
even now it doesn't make sense. Like if you have a loan from 2020, 2021 and it's 2.5%, that's a unicorn. Leave that thing alone.
Seriously.
Just make an payment. It's like free money, basically. You can't touch that at all. That's why we're in the situation we're in with the housing market. No one wants
to sell. No one wants to sell.
It doesn't make sense. You can't.
Yeah. I wonder if this guy is a listener and he didn't like fully understand the full picture of what Dave Ramsey is probably preaching about, why a 15-year is more advantageous compared to a 30-year, because you're building up equity faster, right? And then so you can get out of debt faster if you can afford it. Obviously, if you can afford it. But maybe he just like only took one half of that teaching and didn't think about the whole picture, because the math isn't mathing here.
No, it 100% isn't. So but he does hold a very. I actually like the 15-year mortgage more now in this high interest rate market, because I'm actually seeing. I priced out a scenario for a purchase client right now, or last night, and we were looking at a 30-year on a $700,000 loan versus at 6.875, or a 15-year at 4.875. So it's 2% lower in rate, and it was only about $800 a month difference.
Oh, okay, that's not too bad.
So we're talking about hundreds of thousands in savings on total interest paid. So
yeah,
I like the 15-year. It makes sense in today's market if you can afford it.
Yeah, because the delta you get between a 30 to 15-year on the interest rate is much bigger. Like 2% is huge, or even 1% is huge.
So very wide gap. So when I see it, it's like long-term debt, 30 years, man. It's not where anybody wants it to be in a growing economy, but that 15-year option with the healthy down payment, which is what Dave tends to preach, put a heavy down payment, save for that, right? So if you can do that and get to a 15, it actually makes sense. It actually makes a whole hell of a lot of sense.
Yeah, I remember my dad a long time ago was telling me that he actually prefers 15-year and then just pay it off faster. Back then, houses were not as expensive, so I was, I didn't really understand that. I didn't understand mortgages. I didn't understand interest when he was talking to me. I was, still in college, but now I get it. I was playing with the math a little bit. Just a 1% difference on a $500,000 house, 1% difference in rate is like $300 per month. And if it's like $1 million home, that's $660 per month in the difference.
Depending on what the interest rate is. And then you got to also remember too, the bulk of the interest in a mortgage payment is upfront because of the amortization schedule. So it's always better, if you can afford it, to pay a little extra every month at the start of your
Towards the
30-year
principal.
note, just because you're going to hit so much more of that principal and you're just basically attacking it. So that's the main logic behind a 15-year, because everybody knows, I don't know any 30-year mortgage. I don't know anybody that took a 30-year mortgage that's actually really making aggressive payments. I only have one client that I know for certain that she has, because we did a HELOC for her recently and she bought her home 3 years ago. So to see that go from 400 to 280,000, she went very aggressive in attacking it. So she knows what she's doing financially and budget wise. But outside of those rare cases, it's really hard to get somebody to commit to making even like payments every 2 weeks, and so that you get that extra payment a year. But that cuts off 3 to 7 years of your mortgage. That's insane.
And you have to tell the bank or the lender that, like, please apply this to the principal, or else they're just going to apply it to the regular amortization schedule. Yeah.
Oh, that's a good one.
Making extra payments is fine, but only if you've got the cash to cover like real life situations. So you have to have your emergency fund. You have to consider like there could be inflation. Before the pandemic, we didn't really have to think about inflation skyrocketing so much. It was very stable, around 2%. But now that's something that, homeowners and just everyday Americans have to consider. Like, will inflation or tariff wars or, actual like cyber war or whatever, is that going to skyrocket the price of my eggs back to $7? Like, there's news about gas in California potentially going up to $8 a gallon. Like what world are we living in?
Gas right now.
Gas is like $5, what I'm seeing.
I bet you everybody on the East Coast that's listening to this, they're gonna be like, "What the heck is wrong with California?"
Dude, my family in Texas, they're like, gas is what? $3 is expensive for them,
Yeah.
All right, cool. So let's keep going.
Mortgage you have. If you calculate a 30-year mortgage and you calculate a 15-year mortgage at the same interest rate, in your case 2.5, and you pay the difference, like you took out a 30 and you pay the extra amount as in the difference between a 15 payment and a 30 payment, it will pay off in exactly 15 years.
Okay.
You do not have to refinance to pay a loan off in 15 years. You just have to pay it like it's a 15-year payment, and it'll pay right out, or more, of course, and then it would pay out even sooner. So never refinance just to move from a 30 to a 15, because you take on the closing costs at a minimum, and in this case, you'd go up in interest rate. So you never do that. Just pay extra on it, and you'll get there.
It's good that he stopped where he stopped. Refinancing is a tool. It's need to do it just because you think it's better to shorten the term, whatever it is, right? You have to have net tangible benefit. It has to make sense to you. And if it doesn't make sense to you, stop. Don't be afraid to pump the brakes. Like I tell my clients, like, I only want you to move forward because you understand what we're talking about and it makes financial sense for you, right? I'm not gonna. It's like I see so many people get so emotional and caught up in the moment, and then all of a sudden they refinance out of that situation. It blows my mind. Like, why would you give up your 2.5% interest rate in this particular circumstance? If you got no other choice other than foreclosing, selling your home, or refinancing, then yes, then you have to do it, just to be clear. But it's literally, if your own main goal is to pay off your house sooner and you already have a low interest rate and and the person's telling you to take a higher interest rate to do it, stop. Makes no sense at all.
Yeah, that's a big one. Net tangible benefits, right? That's something that's, you have to consider the big picture.
Be wise. Think about it.
As far as how much house I can afford, we were well within the 25%, kind of calculating it off of the 2.5% rate that we have.
Great.
But with rates now, I know we're not refinancing, but that would obviously put us probably closer to the 30% mark. Do we have?
Well, it doesn't matter. It doesn't matter. You're fine. The reality is your house payment is a fourth of your take-home pay at a 15-year on 2.5.
We qualify you up to 50% on conventional loans in some cases, if there's enough compensating factors to allow for it to happen, right? But at the end of the day, it's like you don't want to be house poor because that's like you're one mistake from losing everything and filing bankruptcy, you know?
Yeah,
So
there's no cushion.
you need to, if we do qualify someone up to 50% in most cases, there's a story behind it, right? It might be just one borrower on it, and then you have a dual income household, right? So it doesn't show the full picture looking at just the loan. So it's like I see a lot, like I'm still hung up on last week's video, like the fear mongering in those people. It's like just because you see a loan application and funded at 50%, that's income, doesn't mean it's the whole picture. Like my wife could be working too, bringing in income, but I didn't put her in because her credit score is lower than mine, and we got a much better rate in my situation. You know, if I'm just it's a hypothetical, so
Sure,
it doesn't make sense. But in this guy's case, though, for sure, don't mess with what you got because it's really good. You know, and then if you're only at a quarter of your net take home, it's like even less than that. So it's net. We're using gross to qualify you for a mortgage, but if he's net a quarter, that is an ideal spot to be in. Because if he bought that home today at the higher price with a higher rate, he would not be at a quarter of net. That's
no way.
There's no way. He can afford to pay more for eggs right now. He's got the cushion.
Or buy some Bitcoin.
I know you're happy right now. I saw where it went.
Yeah, not yet. I'm waiting for more.
Oh boy.
Reason we put that in place is not to keep people from buying homes. And John, people are really mad right now about
because you hate home
house
ownership.
prices. Apparently, I hate home ownership, and I'm an unrealistic old boomer or whatever other terms of derision you can throw at my bald head. But I don't care if you get a house you can't afford. It doesn't affect me. It affects you if you buy a house you can't afford. Jeff's in good shape. He's not got any issues. But here's the thing, and I've been answering this question the same way for 30 years. Like we have people call us from California. Well, Dave, you can't buy a house in California for that. That means you can't buy a house in California for that. That's what that means.
It means you can't buy a house in California. Oh man, that's that's a little blunt. I didn't know Mr. Ramsey can get so blunt.
What do you mean? Have you never watched a whole video of him? That's his whole personality. He's gonna yell at you the whole way through. He's giving you the reality check that no one wants to give you. You know.
That's funny. I don't really watch a lot of Dave Ramsey. I know about him, by reputation. But it means you can't own a house.
But it's like if you really look at it, though, he's giving the people that are in a dire situation a reality check that no one else is going to give them, aside from falling into the rabbit hole of like bankruptcy and everything that he fell into. But aside from that, everything else seems to be.
Yeah, he's very conservative, right, when it comes to debt.
He's not fully against debt, though, by the way.
No, he's not.
He's not fully against debt. He's good with mortgages if you have a hefty down payment and you can afford a 15-year. Just a lot of people can't do that.
No.
I'm gonna skip over because he kind of illustrates this point more.
And so I'm sorry. I'm sorry that when I was a kid I couldn't live in Williamson County. I couldn't afford it. My family didn't make that kind of money. I'm sorry. I had a traumatized childhood. I'm sorry. But it's the way life is. And so, the answer is no. The reason you tell yourself no is so you can tell yourself yes later.
I like that a lot, actually.
That's actually really good right there. Tell yourself no so you can tell yourself yes later. It's delayed gratification, right?
Absolutely. And, a lot of social psychologists talk about how delayed gratification in children is like one of the best indicators of future success. So, to all the parents out there, press upon your children the value of delayed gratification, especially in like this age of AI where instant gratification is going to be so much more accessible and easy. We still need to have those values instilled in us and model that for our kids, right? So like delayed gratification is huge. All right, let's keep going.
And so you've got to break this cycle and not be angry at me or at the world or at Instagram or Twitter or whatever it is you're angry at this week, because house prices went up. I'm really sorry. I don't want you to be upset, and I don't want you to not have a house, but also don't want you to do something stupid that's going to keep you broke your whole life.
I'll throw a third one on there, Dave. I have found in my life, when I've had a 30-year mortgage, and I've had a couple of those in the 15-year, I can have all the best intentions with a 30-year mortgage, but when it comes down to it, every single month, somebody invites me out to a thing. Or, hey, we're all going out to this thing.
Yeah.
And whether I've got the best intentions or I've got all the willpower in the world, it's really hard for me to make that, to double that payment or to make that gap payment between the 30-year note is requiring me to pay and what I could be paying for that 15-year. With the 15-year, I'm locked into it. I got to do it.
Life happens, right? So you might have a plan, and plans change, right? And we talked about delayed gratification. If you don't have that skill, you don't have that strong muscle of saying no to yourself, this is the stuff that you fall into. Like I have this financial goal of paying off my mortgage in 15 years and saving maybe hundreds of thousands of dollars. But if you continue to overspend your budget on a monthly basis, then you can't do it, and you pay in the long run.
100%. It's about being disciplined with your finances, right? I see a lot of situations where people are in their homes and now not in the financial situation where they want to be, right? It's because life happens, and then what you do today affects you downstream, and it can compound. And his idea is to pay off all the consumer debt as fast as possible, right? And just as quickly, it's like overnight, it could feel like nothing, you're fine and coasting, and then all of a sudden you went from nothing to a whole lot of that debt. So it's like you have to make those painful decisions, and really sit down and budget your finances. So not everybody's financially mature, and some people have to learn the hard way, unfortunately. If it's keeping you up at night, you're thinking about it, and it's to be smart about it. In my opinion, a HELOC would be a good option right here. If you have a lot of high cost consumer debt, find a solution and fix it, right? Change it. You got to make the change early before it's too late. Because I see a lot of people coming to me when it's way too late. They've already.
What do you mean by too late? Can you clarify what you mean by that?
So they've already racked on more like $1,400 a month, but then they have like two cars that are like $1,600 each or total, and then you got credit cards and personal loans. And then it's like, wait, you went from a housing expense of $1,400, but you ended up choosing to have two cars, $1,600, credit cards for $500, and then personal loan for like $800. And it's like, how is that possible? How did you go from $1,400 a month housing to like three grand or more on consumer debt? Like, what was the reason for that? That's what I'm talking about. It's like you need a budget, because like, it'd be more work, but depending on the person, like when I talk to my clients, I want to know what their long-term goals are. Do you want to just buy this house? Is this your forever home? Is this something you're going to step into? Then it's like we start having, like, we draw the picture for each other, so we know where you want to be in like 5 to 10 years, right? If it's your forever home, then we're going to start talking about like, what's your plan for retirement? Have you been saving? I'm not a financial advisor, so I can't give you guidance on how to do it, but I always like to better understand, so that like if I talk to you 6 months later or a year later and I tell you, hey, it's a good time to refinance because the rate drops, it makes sense because I know what your long-term goals are, right? Because it's going to end up putting you an extra $500 in your pocket each month to put away for retirement that you didn't before. But I see some people take that other way, and then they take the savings and they end up spending it, and then the compounds even more. It's like you were in a 30-year mortgage, you reset the clock and you're in another 30-year mortgage, and then you're blindly saving $500 thinking you can spend that $500. It's me personally, I prefer to see my clients pay less in interest for the long term. So it's like, if you're going to do a HELOC, it's like, you're going to hear from me in some cases, like, are you really going to make that extra payment? Or are you going to give yourself the 15-year option and put like this, the guy on Dave Ramsey just said, are you going to go with that 15-year option to make sure you make that payment so you're not wasting your money on interest and actually paying down that debt?
Yeah, that's a good point. Like my wife and I, we do a yearly budget meeting. It's a lot of work. I prefer to do it manually. I know there's programs out there that, um, you just plug in your statements and then they just organize it for you. But the reason why I do it manually is because I want to feel the pain of seeing everything that I spent my money on and just like I need to internalize that for like a few days, and then having that memory of that, like, oh man, why did I do this? Why did I do that? That stays with me for a year, and it helps me to rediscipline myself because there's like, I know you need a reward system, right? You have to like hack your brain somehow to grow. And we go through this exercise every year, and we have our goals, like what kind of vacation do we want this year? And so like, and whenever that temptation is there to you know buy that extra coffee that wasn't really in our budget, I always think to myself, okay, am I willing to steal from my future self in this moment? Like that's how I frame it in my own head. I'm stealing from my future self. And then even more, we have kids involved, so like what we're doing to build our wealth and our future financial planning is to set them up for the future, right? So really, I'm not just stealing from my future self, I'm stealing from my future kids. And so when I frame it that way, it makes it more like, okay, the stakes are higher and I have to manage this wealth, this money that I have, this limited amount that I have, as best as possible.
Hmm. No, it makes sense because you are stealing from your future self.
This is the point of the show. Like we're trying to help our audience to make good financial decisions. And,
Mhm.
just because you qualify for a mortgage and a loan doesn't necessarily mean um, you're going to be able to pay that mortgage and be responsible for the life of the loan. The 30 years is a long time, right? And there's a
Oh, it
lot
is.
of things you can screw up in those 30 years, right?
Mhm.
Like you've seen foreclosures, you've seen people default and file bankruptcy. Like, people make bad
Yeah.
decisions if they're not careful.
Life happens, and you're one misstep away if you're going in that direction, like you're talking about financially. Like if you're not paying attention to the consumer debt and long-term planning, you're literally one missed paycheck away from bankruptcy, which is nuts. I like what you said about doing it manually because it's like I started smiling to myself because like I do the same thing. Like I literally have everything in Excel, and then I'm like
Uh-huh.
looking at it, and I'm like, what was this? Where did this come from? I'm like, oh
Yeah.
wow, that was a surprise change to the
Uh-huh.
monthly expenses. What happened here? That makes sense.
Yeah. Money is fickle, it flows towards people who pay attention to it. So if you're not paying attention to your money, it's gonna stop paying attention to you. All right, let's keep
But
going.
smart things on autopilot.
Yes. I don't want
Like
to think about it.
100% of the 15-year mortgages pay off in 15 years or less.
Yep.
100%, or they get foreclosed on. I mean, 100% of them do. Okay. People that take out a 30 promising to pay a 15, the studies say
Or
92% do not.
yeah, 401ks are successful because you don't see the money. It's just it built in delayed gratification, right? So
Yeah,
just wow,
100%.
that's such a interesting and almost like a sad view of consumers and people. It's just like uh, the assumption is you're gonna be irresponsible with your money. So just protect yourself and don't let yourself see it.
It is, but some people need to do it that way because it's so
Yeah,
hard right now to not go online and be bombarded with ways to spend money, right? Or
right. Uh-huh.
like the old saying, like they were saying, like keeping up with the Joneses. You that was
Uh-huh.
because you would literally see your neighbor, right? But now it's
Yeah.
like everything looks great and everybody's on this beautiful tropical vacation into some weird country I've never heard of,
Yeah, yeah.
with their
It's not just
family.
your neighbor. It's like literally the 1% is right in front of your face.
Yeah, it's you just got to be smart about it. You got to budget. But the thing is, he was talking about automation or something, right?
Yeah, what's your take on that?
If you're trying to automate it, you have to be in a place where you're financially stable for that to really work, right? So you can't put yourself into a 15 year if you're not financially able to support that, right? And if you don't have a budget in place, how are you going to automate savings and making sure you put 20 or 30% away for a rainy day?
you think about like if you're on an adjustable rate, you cannot put it into an automation. Like you need to pay attention to that, right? Because
Mhm.
once the rate changes, and that
Mhm.
just screws up your entire budget.
Kind of. It's like it depends. Like adjustable rates have a really bad rep from back in the day,
Mm-hmm.
like with the financial crisis. But it could be a right tool for the right person. So that's a product that's a very niche one. Like you know how you'll say like 92% of people don't make that extra payment like they said they would on a 30 year,
Mm-hmm.
and only 8% do. It's like 1% of the people that have adjustable rate mortgage will do exactly what it's designed to do. You know,
What is
so
it
it's like
designed to do? Can you tell the
it's designed
audience?
to give you temporary relief to pop in a low rated market where they give you a lower payment, right? You're not meant to stay in that mortgage.
Mm.
Like you're selling that house or downsizing or refinancing for certain within the next three to
Before the rates
10 years,
adjust.
whatever before
Yeah.
the adjustment period ends. Like
Yeah.
you when you bought that house, you're like, okay, I'm only staying here for like max 5 years. So that's why I went with the 7 or 10 year arm because it was
Mm-hmm.
the lowest rate possible. And some people did that strategically, right? Like there was a time period where I was seeing advertisements for on a 30-year 10-1 arm with
Mm-hmm.
one of the bigger banks at like 2.25, right? And then you see like interest rates down 15, down under 2% at like 1.75, 1.5, like rare ones, right? It was nuts to say the least.
All right. I think that's a good place to wrap it up, Jason. So let's give some takeaways for our audience. We talked a lot about a few different things. Financial success isn't just about avoiding debt; it's about using it wisely, right? Um, Make sure you're budgeting. Make sure you're staying within some sort of plan. Like if you're not planning, start planning. All right. Talk to your wife. Get a budget in place.
It's painful, but you really need to sit there and do the budget yourself. Like when you have all of these tools online where they're like, oh, we'll calculate your monthly expenses or tell you XYZ, it's too simple.
Yeah, final note, don't underestimate the power and the importance of delayed gratification. Do yourself a favor, instill that value early into your kids. Do little things here and there to build up that muscle, in yourself, in your family, to improve the ability to say no to yourself, right? And so in order that you can say yes to yourself in the future. Um, so I think that's it for today. Remember, there's a lot of noise out there, but continue to stay patient, do your research, and stay informed with the right type of content. We're doing our best to bring you value and unique perspective with each video, and support us by subscribing, liking, commenting, all that good stuff. And we'll see you guys on the next one. Bye.